Good evening, ladies and gentlemen. Welcome back to Walk the Block. We are navigating digital finance all together. That's right. We had the last Fed meeting of the year. So, as you can see by the title, rate cuts of Fed meetings past, present, and future. Yeah, we're going to be talking about that, what's possibly coming up for the next one. And then outside of that, we also do have two major announcements. One of them is from JP Morgan. The other is from the CFTC themselves. They are talking about expanding stablecoins into the speculative markets to actually start being used as collateral. That is also where we're going to lead into a little bit of a discussion about, well, why does that matter? Is it buying up price? Not necessarily, but it's creating something else that you might know as the network effect or Metcalfe's law. So that is what we are talking about tonight. Hello again. I'm your host, Zenith. It is a pleasure to be back with you guys here on Monday, and I'm joined by my excellent co-host, Tracker. How you doing, buddy?
Always excited to be here on Mondays, man. Trying to digest everything. We're going to get into it, of course. Try to understand what's happening across the markets, and just diving into a lot of things that we're seeing and trying to forecast as well, like everybody else. I think we do a pretty good job here trying to connect the dots for people to understand the direction things are going. Well, like I said, we're always trying to navigate through it till we can figure out what's coming next, like everybody else. Excited to do it.
Absolutely. And by the way, special hello to Centurion54X. He says, hola, amigos. Happy holy days. That's right. We're in December. Happy holy days to you as well, my man. Look, are we getting towards the end of the year? Yes. Is my cynical former government worker take that nothing happens between the week before Thanksgiving and the week after New Year's? A little bit, yeah. But at the same time, the markets are still going, and we are actually getting some surprising traction on certain things, not necessarily government related. That's for sure. I mean, I was looking at an article saying that the the newest crypto bill in Congress just got punted to next calendar year. So there's that. But good to see you, Centurion. And yes, we will be getting into it. So let's not waste any time. Let's get to the man of the hour, aka Jerome Powell. Which, by the way, I do want to state, Tracker, I know you've been following this one about who's going to be his replacement and whatnot, but they did straight up ask him. They're like, hey, you got 3 more Fed meetings. How you feeling? What's your legacy? And he's like, I just want to make sure that it's a good economy when I leave. And I'm like, I can understand that. Already.
He's ready. The hard work for him is done. Now he's going to go off and get paid big bucks to be a public speaker and be a talking head on various shows and probably write a book and all these other freaking deals. So he's going to reap the rewards most likely.
Hey, that doesn't sound like a terrible gig afterwards. They did ask him though if he was going to stay on for the so he's not going to be the chair anymore, but he does have the ability to stay on the board of governors, if you will. And he kind of dodged that question and said, I don't know. We'll figure it out when we get there. So
he's not going to do that. That would be a step down. That would be kind of like, to be demoted and kind of thrown this. Yeah, that just to keep face, he would leave, and rightfully so. I mean, I couldn't imagine him wanting to stay once you're replaced, because you already see the direction going. You're going to be butting heads and it's going to be a fight. It's not necessarily worth it. Like I said, he can move on and do a ton of different doors open for you. This is why a lot of people do get into the politics or the Fed areas, because the opportunities are just it's just a cornucopia of options you have at that point.
That's true. That actually makes a lot of sense. If you're just going to get downgraded there, you might as well just go off to greener pastures. Alrighty, so headline story. Yes, we did have another quarter point rate cut, as was very widely predicted by both the betting markets and the futures markets. But outside of that, today we're going to be looking into why exactly did we cut and why did we cut this meeting, and what are the odds we're going to be cutting in the next one. So with that being said, please let me know if the audio is an issue. But other than that, here we go.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
There you go, right off the bat. So, according to Jerome, it appears that we're at the magical neutral rate, where policy is neither too restrictive or too lenient. So the question is, where do we go from here? When I was listening to this one, I was kind of thinking this feels slightly different from the past meetings that we've had, which is that he's talked about the policy of the Federal Reserve is more of like they're on a trajectory, but this language right here seems more like they've arrived at the destination. I know I'm reading in between the lines a little bit on this one, but he brings up the fact that we've had 3/4 point cuts, and then he also even goes back all the way into September of 2024 and talks about the last round of rate cuts along those lines and says, look, we're down almost 2% from where we were like 15, 16, 17 months ago. So I don't know. Based on the language, does it sound like he's looking for another one, or is this where we're going to be sitting for a little bit?
Well, I wouldn't say necessarily in this meeting is where it came out, but that seems to be where people are leaning towards, is that they're acting more hawkish, that there's kind of division across the Fed right now as far as the board and whether or not they're going to do another rate cut or not. That's the kind of thing that's starting to spook everybody. I don't know if it really, I don't know if I got the feel from him himself that they were going to do anything with stemming or slowing down the rate cuts going into January. Like, I didn't get that from his conversation here. I didn't see it.
That's fair. That's fair. You brought it up. It's not in my highlighted clips, but he was directly asked about the dissenting votes. They had 12 people voting. 9 people voted for a 1/4 point rate cut. 1 person voted for a 1/2 point rate cut, and then 2 people voted for a no change at all. So that's the dissent that's going on right there. And then additionally, they did update the projected forecast or they gave us a little slide of it in the beginning, but they were showing that their projected federal funds rate is right around that 3% level. Right now we're at 3.5. So 1/2 point above where they want to be in the medium to long term. So they're looking end of 26, 27, that kind of stuff. Granted, all that stuff's very speculative change, but at the same time though, the reason that it got me thinking about that this might be where we take a pause real quick or we kind of let it simmer is that they're already getting split both ways about, do we cut more? Do we not cut at all? At the same time, they still arrived at 1/4 point rate cut. And then also looking further into the future, it's less far to go to their trajectory than where they were in the past. So previously, before we even saw the rate cuts, we were looking at it and they're like, these guys are predicting like 3.25% interest rates. And we're sitting up at like 4.25. It's like, you're gonna have to make some moves to get there. Well, we just got 3 moves in a row. So how much more you want to go?
Well, since they had done quantitative tightening for so long and they had kept their interest rates up as long as they have, and they probably should have already been acting on this much sooner. But Jerome Powell always drags his feet, and I get it. He's cautious, but unfortunately, when you're cautious, things get a little more worse by waiting longer. So I can make the case or make the argument to saying that, yeah, if they were cutting sooner instead of just starting to do it, a few months ago, we wouldn't be in the predicament we're in. So they may need to be a little more aggressive. And I guarantee the new administration coming in is going to be certainly more aggressive. Keeping in mind, the big push here we always talk about is there's a lot of players that want lower rates. They want people to be able to, that's going to help the housing market, which I'm going to bring this up. I don't want to get disturbed, but there's a whole bubble problem facing the housing market right now. It's just really starting, honestly, to really get going. So you have that going on. You also have all the debts that are out there that get refinanced at a lower rate. That means the U.S. debt as well. I know they're using treasuries, stable coins to buy up a lot of the treasury debt, but ultimately the administration wants lower rates. And then we've already said it's going to happen. It's just, unfortunately, until Jerome Powell, is he going to stymie this and going into January? He's a data guy, so he's going to wait till data comes in and tells them if not they have to take action or not. And I think that could shift. Right now, the settlement is, I think most people think, well, where's it at right now? Where's the rate? Do you have the the percentage of chances of a rate cut in January? Do we have those numbers? Because I'm assuming it probably would have dropped significantly due to the dovishness.
That
I'm
it
sorry,
did.
the hawkish, I should say.
Yeah. So what we're looking at here is this is January's prediction. This is coming to us from our FedWatch tool by the CME Group. This is the one that watches the futures markets. Right now, we're looking at 75% chance of no rate cut in January. Before this, we pretty much had similar, well, about a week ago or day ago, we had somewhat slightly different numbers, 68% chance of no cut in January, but also an 8% cut of that no chance at this last meeting. So the difference here really is that the numbers that were the 8.5% that were no cut, they got more than the no cut data of this one. So overall, right now, what we're looking at is most likely no change. But then again, we are 43 days away, and a lot can happen. And then, especially considering that this is going to be one of the first full months where we get real solid data. It was one of the things that he mentioned in the opening was that they haven't really gotten full data. They didn't get it in October. They got half of it in November. So December is really going to be the first month where they're back in their groove from getting good data from the Bureau of Labor Statistics. And that's probably what they're going to be looking at. I mean, if you take Jerome Powell with what he says, which is that we watch the data, well, there's your data.
Correct. We're going to be looking at the data. They're going to take action then. But as you can see, another rate cut in January is less likely. Is it correct? Yeah.
That's what we're
here
looking
we
at.
go. Holly market. Yeah, here we go. So 21% chance, 78%. That seems about right. That seems about right in line with what we are. And honestly, all these other markets now, the poly market is just basically taking over everything. Because anything you want to speculate on, it is out there. So with 21%. So think about this. So let's say that comes out, but then the data comes out. That's going to catch the market sleeping. Then there might be more chance to be another. Anytime you catch the market to the upside and good news, you're going to see a good reaction. I think it could happen again in January. I'm not going to sit there. I don't want to sit here and just keep speculating, but as of now, sentiment is most people are not expecting another rate cut coming in January. But so that's already kind of getting baked into the market now, which is why things have kind of calmed down a little bit since the rally we had coming off that news.
Agreed.
But if you look at the traditional markets, I mean, the U.S. traditional markets, they're all towards their all-time high. The Russell had a pretty strong move. It's still hovering up. It backfilled in the gaps, but it's still up there at the all-time highs. So everything's near all-time highs. Gold is back towards near its all-time high, kind of stifling out. Silver has gone parabolic to try to catch up to the move that gold has run. But I guess what I'm looking at, like everything is near its all-time high. I'm not seeing any hard pullbacks or the market's rejecting it. Keeping in mind, we are in December, so like we talked about, we don't expect a lot of action to happen. I was more surprised at how much bullish action we got because of the news that came out in December. But the overall crypto market is pretty flat, sideways. Bitcoin's come all the way back and backfilled to its recent all-time lows. It's still kind of there. Ethereum's holding up better than Bitcoin. It's trying to form like an up channel. I guess what I'm ultimately trying to say here is the markets are digesting this. They're not happy about it, but they're digesting it okay. That's the best way I can put it. And I think everyone's just kind of wants to get through December and get into January to see what's really going to happen in the overall markets.
I think that makes sense. And one of the reasons why I say that is that if the assumed trajectory was to continue cutting rates, then the markets would continue their upwards trajectory. We got this Fed meeting, which it's no announcement of what's going to happen in the next one, but it's a decent window into what's going on in the mind of Jerome Powell and the rest of the people that vote over there. And I mean, as the betting markets and the prediction markets show, it's changed a little bit, and it's looking more like, well, we might actually have a flat month there. So because of that, markets maybe looking a little more flat, still near their all-time highs, continuing that trajectory from the past. But now they have to recalibrate and figure out where to go from here. But that makes sense. I do have our second clip here talking about January. So let's see what they have to say about that one coming up.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down. to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple of things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000. So that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall, that was the judgment that we made, and that's the action we took.
All right. Two things out of that one. One was a little tidbit he threw out there that we're going to get to in the final clip, but that's the payroll jobs estimation there. I don't know if you caught that. They've been estimating 40,000 new payroll jobs every month, but he's saying, I think it's negative 20,000 every month, and it's been that way for a few months now. So that's why they believe that the jobs market picture looks the way that it does. Other half of this statement. Go back to the dual mandate. Dual mandate at the Fed, full employment, stable prices. Okay, full employment, that's pretty obvious. Unemployment rate. Stable prices. Well, is that inflation or is that cumulative effect of inflation? Jerome Powell's going to argue it's more of inflation because you can't really change past prices. Once things go up, they don't really come back down. And what he's pointing to with inflation going on right now is that they believe a lot of it is largely tariff-based. And because it's tariff-based, that means comes in once, and then after that, it's pretty much done. So he talks about it a little bit with the story, saying it's the story of inflation for tariffs and whatnot. But at the same time, the numbers are what they are. So the reason they cut this month and not in January is, well, they believe that they saw a continuation of a trend. So the question is, okay, does the trend continue next month as well, or are we going to actually see a change? So.
Well, that's really interesting. The fact that that they've been thinking that it's been 40 plus every month, and there's negative 20 every month. That's a big discrepancy. So, and keep in mind, they're taking action. Like she asked a question, why did you guys cut now and not in January? Well, the data said it. The blunt answer, the short answer is that the data told them they needed a cut. So I guess what I'm thinking is everybody's saying like, oh, we're going to hold off on rate cuts in January, but you just they're data driven. So if the data is screaming that you need to take action, you're going to take action. So really it's going to come down to what the data says, and anybody can put your bets on how you see fit. But until that data, unless you have access to that data before anybody else, I don't know how, that's going to determine which way thing's going to go. I don't see anything in the economy telling me things are calming down. I mean, yes, there was a massive wave of cuts, certainly in the technology sectors, and well, not just technology, a lot of companies were cutting, but that's cutting 10% of your workforce or 20% of your workforce is nothing. I get it. It's horrible on Main Street with a lot of people getting lost. I don't wish that on anybody. But where I'm getting to is 10 to 15% cut of a company's employee staff is really trimming off the, I don't want to call it the fat because those are people. I'm just saying you're trimming off where you think you can trim because you think that it's time to kind of stop spending as much because you need to get more defensive on how you're structuring your company. But we saw in a couple months ago or a month ago or two ago, we saw companies cutting like 30% of their workforce. I was tremendous. So I think it's a combination of the economy and the threat of AI, which once again, beat this story up a lot, which is everybody keeps thinking AI is this, the people on the board of directors of these companies and upper management look at these, AI advancements as like, this is a silver bullet where I can just, take out a good chunk of my workforce because it'll just do everything. If you have your house in order, sure. Most companies do not have their house in order. The smaller companies tend to be more house in order because they're smaller, they have to be more aggressive, but the larger companies, they tend to stumble a lot of areas. They have a lot of technical debt, let's just put it that way. So
That's fair.
it's going to come home to roost on the AI bubble, but I think it's a combination of AI and I think it's a combination of the economy. The economy is rough out there, and I don't care what anybody says. You can chalk it up for inflation, tariffs, whatever. Things are a lot more expensive now than they have been, and it just keeps getting worse. And you add in the fact that people losing their jobs, I don't see how it's not going to translate to a overall good economy. I don't see all of a sudden, if the trend has been losing the negative numbers for unemployment, I don't see how it's magically going to turn around in January outside of they might use it as an opportunity to leverage the way they classify it, because they don't look at it, I don't think, part-time and full-time, do they? They look at it more like, are new jobs created? And we know what happens in the holidays in the United States, more jobs get created because it's a temporary job to help with the retail, specifically the retail sector, and logistics, companies that have to ship and move things. We know that. So that's a possibility where you might see in January where there's not a negative but a positive. But that's a false flag, of course, if that does come the case.
Yeah. Look, Jerome actually was talking a little bit about AI in this meeting as well. Wasn't quite as pessimistic as you and I are, perhaps, but he was saying, like, look, is AI responsible for job losses? Maybe. He thinks it's a little overblown. Did compare it to the dawn of the internet and the dot-com bubble and stuff like that. He said that the thing about that kind of economy was that, were there jobs that were destroyed as a result of the internet? Yes. Were there also tons of new opportunities and other jobs that opened up as a result of it? Most definitely, yes. AI might be a little different because it's not about new technology for actually opening up markets to make them more accessible. It's actually more about kind of the workforce or the amount of human capital or effort you have to put behind whatever it is. Streamlining, exactly. But one of the key things he really pointed out this meeting actually was that productivity is up, and productivity has been up over the last like 4 or 5 years. The reason that he looks at that thing in entirety is that because it goes back to the old COVID days, which is that everything got shut down, a lot of stuff went online, a lot more online for sure. And he's saying that, has any new technology in the first 2-3 years of that really progressed to the point where it helped humans do their human work better? The answer is no. So it's part workforce, part working better with technology. But then the second half of that story is AI, where you're actually starting to see it come in and actually do some things that previously might have had a person do, that kind of stuff. So that's why his stance on the whole AI thing is like, is it driving unemployment? He doesn't happen to think so at the current time. He definitely sees a possibility for it, but I think he's going to have to see a lot more when it comes to AI for actually replacing people en masse. And I understand the perspective, but at the same time, it might also just be classic Jerome, which is he's always just a half step behind the beat, so to speak.
I can certainly tell you that companies are aggressively looking at AI to cut jobs and stuff. I'm seeing it across the technology sector, certainly. I'm seeing it in other areas. Companies love to chase the new shiny ball. right? It was with the dot-com bubble. We saw it with migration to the cloud. We saw it with anything that the board wants to show as a company being competitive, essentially staying up with the Joneses, right? Oh yeah, look, we're doing that too. Whether it's just a campaign or as optics for shareholders, you want to always be doing this. And companies are going to go that route. And then when you do this, companies, then those people making those decisions are given piles of cash. In return, those board want to see what they got return on the cash. So whether or not it was successful or not, they then have to start cutting jobs to sometimes make drastic measures because you promised board of directors actions on what you've taken. And I think you're going to see this correction come back, and that's where you're going to see companies losing a lot of money going to AI because it's not quite ready. People tend to rush to the new things and they're not ready, and I think that's what you're going to be end up coming down to it. But you will see that. That's just the way I look at it, period. So
I'm right there with you.
I think they already have been aggressively moving to AI, and I get him, but it could also be the economy is worse and it's being used. I get it, but definitely there are companies that are jumping the gun trying to state that AI is going to solve their problems, whether or not it's the root of the problem or not. But the AI narrative is going to keep getting spun. All right, what else we got from JP here?
So let's dive in deeper on that negative $20,000 or 20,000 jobs per month stat that he threw out there. So we do get a follow up on that one.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think it's I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey, and there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month. So 40,000 jobs could be negative 20. And, that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low. If there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
There you go.
A lot of tap dancing. A lot of tap dancing.
Look, you're not wrong. But I think he had a really good point, especially in the first half of that clip there, which is that they do the unemployment count via survey, not real-time data from employers. A, because that'd be very hard to do, probably might affect some PII laws for personally identifiable information and stuff. But at the same time, though, it's a survey, and they believe that they have identified a trend in the survey. He does say they do correct for this over time, but he was referencing months, not like this next one, like, I don't know what month they're going to do it. What month? Good sir, you're like, at best, we'll call that like, I don't know, 3 months. Worst, we'll call it 6 months. So if you're relying on the data, but you know the data is skewed, it doesn't really help the argument a whole lot there. Even though still, I know it's still part of the tap dancing, but he did give his little band of confidence, which is like, look, we've estimated they come out 60,000 ahead of where they probably are. And even that, give or take 10 or 20,000 either direction on that 60,000. So in Jerome Powell's mind, we could be anywhere between 0, neutral or flat, and negative 40,000, as opposed to his 20,000 is the middle number there. So like, hey, the data guy is working with what he's got, but at the same time, I think he's at least like saying it out loud. Like, look, these are imperfect numbers. It's an imperfect world, but this is what we got.
Right now, everything's speculation. Like that's basically what he was trying to do. He was trying to tell them, like, listen, it could be this, could be that. We're not sure. You know, you're asking a lot of questions that are extremely loaded questions that you're not going to have a definitive answer to. Period. But I will say this: if you're looking at the numbers of the overall market, so I've got them up here per month, going back to 2023, right? So in January 2020, we had 500,000, 500,000 jobs were created, right? That was strong post-COVID recovery stuff, right? And then we had like 300, 100, 300, 300, 200, 100. So like a lot of above 200 mostly, right? All above 200, right? Strong growth, right? And then all of a sudden, right around July of 2024 is when the slowing trend started beginning, right? That's 2024 in July. And then we started seeing more like around 100 was normal. And then we got a preliminary low where it shocked us. Only 12,000 jobs created in October of 2024. So, okay, then we bump back up again to the 200s. But then all of a sudden, going into 2025, everything started it started showing a much more rough picture. In January, 143, February, 151. Then in March, only 79, April, 108, May, 12. June 206, July negative 4,000, and then August was less than 100,000, and September was about 100,000. So that was manufacturing ticking up slightly, is what they stated. So we don't know what the numbers have come out yet for October, November, and December yet, because like you said, what is it, 3 months behind? So it's very backwards looking. But yeah, if you look at it overall with how we were rolling through in 2023, 2024, stumbled a little bit going through 2024, and then we've really been stumbling through 2025. So yeah, it's looking pretty dire. So to me, it tells you, yes, the Feds need to be probably still going to be watching it closely. Like we said, it's going to be data driven. So whatever comes up in January that time or whenever they get the numbers that came out, keeping in mind those numbers, I assume are going to need to be October. So because they said the report canceled due to government shutdown, that was in October, and then the report was due December 16th for November. So I'm assuming they got that number. I guess that number is the one that they're already looking at, or they're going to release it in after today. That would be November's numbers. So that's kind of where we are. I just find it hilarious. Like, I'm sorry, I got to put my conspiracy hat on. You don't have any numbers or any information because the government shut down for the month of October. Come on.
Well, he was boasting about, oh, we have access to companies and markets who give us their data, and it's really good, but it's not BLS, and we're not allowed to release it. So it's like, do I believe that part? Yeah, I believe that the Federal Reserve definitely has inroads with, or at least has a good finger on the pulse when it comes to whatever companies are operating in the area of the regional banks.
Mm-hmm.
So that makes sense. At the same time, though, it's like they're not going to release that data, so you kind of just got to like trust me, bro.
Well, keep it in mind. So in January when they meet, they're only going to be looking at numbers that came out for December, correct? Is it a month behind, 2 months behind? Like I'm just trying to figure out how far, like, because like, so yeah, this was due on December 16th. So they released the November data. So they got the notes, what we looked at. So yeah, they're going to be looking at December. But like I said, the only thing that can help December would be the hiring jobs. Hiring because of the holidays. That's the only thing I could see that you might get an uptick.
Yeah. So January FOMC meeting is going to be the 28th of January. At that point, they will also, because it's every like 45 days effectively, and the job reports come out every 30 days. So they're going to have the December one, which is supposed to come out tomorrow, I believe. And then they're also going to have the January one as well. But then again, you're covering the months of November and December because they're 1 month behind. So it's like, I don't know how useful that data is going to be. You can have your seasonal inflation
I'll call
or
it now, man.
adjustments.
I'll call it now, just on what you're seeing on the trends. It's going to be around 100,000, maybe sub 100,000, and that's at best. Which would put it, just to put it in perspective, December of 2024 was 256,000 created, and then in 2023 there was 164,000 created. So yeah, everything is pointing to down. It's not. Well, the reason why we're going over this so much, people are like, okay, great, we're just speculating on numbers. But the whole reason why we're looking at this is what they're going to decide whether or not they're going to do a Fed rate cut or not. And they sit up there and like they did just the same shenanigans they pulled a month ago when they came out there and Jerome was like, well, not necessarily we're going to absolutely cut in December, even though we all knew you're going to cut in December. You're going to cut. We know you're going to cut. Yeah, he put it out there and that spooked the market. Same thing's happening now. People are getting spooked again, like, oh, you may not cut. Well, most likely he's going to cut in January. Now, I'm not saying for sure. Obviously, the data needs to come out, but if the trend is that it's going to be weak numbers again, it's highly likely that I think they're going to end up cutting. But as of now, the markets overall think because of the talk, but we keep seeing this talk constantly coming out. So I would not look at what they're saying and doing. Just look at potentially forecasting based on the numbers to get an idea which way we may go. I would probably be more. I would be more surprised if we don't cut in January, because they asked, because like he said, they're going to keep a close watch on these numbers, whether it's AI or what. It's almost like he's not. So the good news about it is they're not going to use AI as an excuse. If the numbers are bad, they're bad. They're not even considering that right now, and that's basically was the takeaway from those questions. So if the numbers are bad or not good, they're going to do a rate cut. Pretty much how it's going to come down.
That's fair. And I guess to put a bow on this is the third quarter point cut in a row that we've had. Notably, though, this is the first meeting post quantitative tightening. In the opening statement, he did talk about they were planning on having a $40 billion increase in the liquidity for the markets every month, starting with this one. So, not quantitative easing by any stretch of the imagination, but notable increase, especially if you keep stacking it up over time. And then eventually, there theoretically will be that shift where they do start to go more into quantitative easing once the rate gets low enough to the point where they don't see any value in lowering the rate anymore, because you're approaching zero. You can't go below zero. So the closer you get to zero, the more you have to look at other options. So as it stands right now, we're we're looking at probably 4 months now of lowering interest rates, starting to boost up liquidity in the markets, looking at assets. This is theoretically the beginning of the time when that kind of stuff starts to increase in prices, because money is easier to come by. There's more of it flowing around the system. And based on that, it means that there is going to be a little bit of the usual inflation. Things that inflate, assets. They do, because people are looking for places to park their money. So that's why we care about it. Hear me out. I'm kind of in agreement with you, but I'm really 50-50 on it. I could see January being another cut month. I could also see them pointing to ending quantitative tightening and trying to allow a little extra buoying of the money markets to kind of support that as maybe like a stopgap while they take a breather of a month. But I mean, would I be surprised if they cut again? No, absolutely not. It's in line with the trajectory, but overall, based on what I saw today, it was a different tone from Jerome Powell. Because I remember the last meeting we were at, he was getting a lot of questions about people like, oh, are you doing another cut? And then he was like, stop trying to predict me. And this one, he's like, hey, we got the neutral rate. And they're like, cool. Why'd you do this one and not when we were thinking about maybe taking a month off? He's like, just felt right. I was like, all right, this man's happier. I guess he's less frustrated with everyone out in the crowd.
It's strictly data driven, man. That's what he's going to make his moves on. It's going to be on data. So, yeah, we'll cross that bridge when we get there. I just think it's interesting because they need to be more aggressive, unfortunately. But short term, it's going to make everybody happy, but it's going to, like you said, it's going to cause much more inflation when they do all this stuff. The fact they're injecting the markets already with 40 billion on the side and taking those aggressive natures doing that stuff, it's still injecting liquidity. It's still devaluing the dollar, like you're saying. It's not good. But like you said, what they would probably do, what they normally do, is they'll keep cutting rates. And if they got to get more aggressive, they'll cut rates, and then they'll really start lowering the rates down more and more. And then eventually, at some level, they will start kicking in quantitative easing. That would be the final piece. And then if they have to, they've called it the bazooka. They've called it all types of things, where they'll just inject a ton of capital and just really get things going again. But that's the thing, though. We're not in a liquidity crisis. Now, there's a debt restructuring that needs to go on, but we're not in a liquidity crisis. The way it was described, yeah, if I give you more money, is that going to fix your problem? Well, not necessarily. Not if people can't pay it back. But if people can't pay it back, am I going to really going to loan all this money out and to see it not come back? I mean, it's not going to really fix the problem. So we should see. Is basically what we shall see.
Very true. Alrighty, that's enough Federal Reserve, our favorite topic around these parts. Anyways, let's keep it going with something else. So, two stories tied together, but we believe that they are important to talk about a larger concept, which is the network effect, or otherwise called Metcalfe's Law. But we'll get to that part in a second. First up, coming to us from Business Insider, JP Morgan is jumping deeper into crypto with a new tokenized money market fund. Interesting. We were just talking about money markets. Now crypto's getting in on it too. Let's see what they have to say. JP Morgan is set to offer clients access to a tokenized money market fund as part of Wall Street's latest crypto push. The bank announced that its asset management arm will launch the tokenized money market fund that will run on the Ethereum blockchain. My on-chain net yield fund, ticker MONEY, MONY, will be supported by Connexus Digital Assets, the bank's tokenization platform. Money will hold short-term debt and issue daily interest payouts in the same way traditional money market funds do. The key difference lies in the fact that its shares will exist on the Ethereum blockchain network, and investors can redeem them using either cash or USDC stablecoins. There you go. I know it's just the top line story there, but hey, stablecoins, they're getting further into the markets here, largely due to the Genius Act that was signed earlier this year. But there it is. Are we surprised?
Not surprised, but Jamie Dimon, I've got my own choice words for him, but I'll keep that reserved. I mean, he's the one out there telling you. I remember when it was hilarious. This happened years ago, where he was saying how crypto is just for basically black marketing and that it shouldn't be looked at and used for anything. Yet this is the same company who was tied to the largest cocaine drug dealing bust shipment that came in for that they were tied to. And so I thought that was always a funny, interesting thing that looked at it. So Jamie Dimon, man, he's a trip. That guy, I tell you. And he's also on the board of, he's on the banking board, which is funny that people don't understand that. So it's so obscure. The bankers are on, like, we'll say C-SPAN 3, an obscure channel nobody in the world watches, and they're out there. They're basically policing themselves. The bankers. It's comical on so many levels. The theater is just, it's ridiculous. All right, that's another soapbox I'll get off of. But where I'm getting at, I find it so funny because he was so anti-crypto, and here they are jumping on with it. And he'll say like, "Oh, it's not. I still don't necessarily think crypto is good, but we're going to use the technology." Okay, well, you like the technology, it's fine, but them and everybody else under the sun is creating their own stable coin. Now on this one, it's actually tokenizing their money market funds. So I'm assuming the money market funds, if you think about money market funds, they're the same like you see in 401ks, IRAs, retirement funds. A lot of times a money market is basically, if you have those types of investment vehicles, you typically, if you want to go to cash, you would rotate all your money into these money market funds, and it tracks kind of like it kind of stays flat. So if you wanted to take profits and go into cash, you'd go in a money market account. And that's what this money market funds would be. But the fact that they're tokenizing it is interesting. So the question that I have, did they talk about what's backing this by any chance in the article? Like, what do they have backing it?
They have a commitment to put $100 million of their own capital into the fund before opening it.
Okay. So they're going to back it based off of that. And so the thing here is it's no different than what they already have, but they're moving it over to the tokenized Ethereum network. This is the narrative we've been talking about for, man, forever.
Years,
more and more
years at this point.
Yes, that everything is, I'm not gonna say everything, because if you notice, XRP just moved over to Solana. That was a very interesting move that happened last week. So I'm not saying Ethereum is going to be the end all be all, but if you believe in people like Tom Lee and all these other big folks, JP Morgan certainly is on board with it, that Ethereum is the one that they chose, right? That Ethereum, why would Ethereum? Because it's the biggest guy on the block. It's the one that's been around the longest. It has all the smart contracts. It's scalable because it's proven to be scalable. Solana network, unfortunately, has had it's gone out a few times here and there, but because they're trying to solve bigger problems. They're trying to figure out more things that are interesting, but I don't want to get in here nor there. Ethereum network's being picked because the fact that it's out there, it's already huge, it's massive. Most of the transactions are happening on Ethereum network, and that's why most people are assuming it's going to most stuff's going to get tokenized on there. So am I shocked by this? No, I'm not shocked whatsoever. I think you're going to see a flood of this coming a lot more aggressively and faster at a much alarming rate than people realize it. Keeping in mind, who was the oh man, I'm drawing a blank now. The SEC, who was the gentleman? Because I know Larry Fink has been all about Larry Fink. If you don't know, he's CEO of BlackRock. He's made it come out many times saying that they are going to tokenize everything they're going to tokenize everything. Well, if they're picking the Ethereum network, that's going to tie into it. I know we'll get into the Metcalfe's law and the network effect and all that stuff later, but I'm just saying though, if everything's pointing to that direction, that's going to be very interesting. I forgot who was the gentleman. I think it was in charge of the SEC that was saying like how in the next 2 years to 5 years, everything's going to be tokenized. We were joking on it. I said one time I thought that when I first looked at it, it was Rand Paul, but it's actually, who was the gentleman?
Paul Atkins.
Paul Atkins. Yes, thank you. So Paul Atkins came out and literally said, now who's Paul Atkins, Zena?
He is the current chair of the SEC. Previously, he was actually back working the SEC in the late 90s, was also chair of the SEC from 2004 to 2008 when they launched the original gold ETFs on the markets as well. And now he's back for more ETFs, theoretically.
So we would say somebody who's in very powerful position to know what's coming, most likely, or be in the know of how things are going. Well, he came out and stated last week or a couple weeks ago that within he could see it as soon as 2 years, but as potentially up to 5 years, that he expects all U.S. Markets to be tokenized. Yeah, if you take all U.S. network, all U.S. Now, when we say that, we're talking equity markets, we're talking bonds / fixed income market cap. We're talking about
stock market's a big one.
The stock market's the big one, but all of these, the housing market potentially. Then if you start moving all that stuff over, then you start having a massive effect. You're talking trillions of dollars worth of stuff. We're talking, I think treasuries dominate that as well, because like there's 225 trillion, but bonds are 240 trillion, equities 125 trillion. So totaling of $365 trillion worth of things that could get transferred onto those networks. Now, these seems like crazy numbers, but the whole point, we'll get to this in a minute. So my first question before we move down that rabbit hole is, did we wrap up that article? There's anything else you wanted to cover?
I mean, the only last thing is a funny little tidbit about who do you think it's going to be offered to? And the answer is wealthy clients and institutions with minimum investment of $1 million. And it's wrapped up right along with the people from Wall Street and the crypto push, namely Franklin Templeton, Fidelity, BlackRock, as other folks in offering crypto investments. So,
right. So basically nobody unless you're in the club, right? That's just called what it is. So, so all of these big players are moving. They're going to tokenize everything. Everything's going to, whether we like it or not. Yes, I don't like the idea of everything going tokenized, but from an investment standpoint for crypto, it's going to be a tremendous opportunity. People have stated many times, this is the largest, how do we put it? This is one of those major moments of shifting that we haven't probably seen since, I mean, you could go back probably to the Industrial Revolution. But this is a significant point in the entire world on how money has shifted. I mean, people who read and understand the fourth turning, that not Carl Icahn, and it simulates the rise and fall of all major powers, and as well as the rise and fall of all currencies. Now, is the U.S. dollar going to go away magically overnight? No, it's not. Even though they are getting rid of the penny finally, thank God for that. But what I'm saying, it costs more to make than it. So, but paper money, I don't see it just going away entirely. I think it's going to be, this is going to be a transition, but it is going to be an aggressive move. And I don't think people quite understand that you're seeing an amazing shift in how the entire financial institutions are going to be working around the world. I mean, it's coming aggressively. Now, it's interesting because I think most people that won't really understand that, because if you think about it, most people are used to paying with PayPal or their smartphone. Like you've already been kind of programmed how to do this.
Oh, yeah.
You just won't see it as a user how it's actually working behind closed doors or what it's on. Yet it's going to open up, like we dove into the whole Tom Lee article last week that really dove into understanding why it's not just digitizing things. It's not just putting it out there. It opens up a whole new market in a way to open up a whole new markets that are out there. A perfect example is the poly market we talked about, like that whole thing being tokenized. I mean, we're moving in an aggressive direction. So where I'm getting at here is this. If you have $365 trillion, and let's say some of this stuff does get moved over and migrated over to the Ethereum network, let's just say if all of it got moved over Ethereum, it doesn't even have to. I just want to throw these numbers out to people. So if you were to move that over, today Ethereum has 400,000 to 500,000 daily active addresses currently. If full US tokenization, it could be anywhere between 10 to 50x that time of volume. That would push it more up to the $5 to $25 million million transactions a day, not dollars, but the actual transactions. And there's a lot of formulas that go into this too, but the gist here is it would cause what's known as Metcalfe's law, which is the network effect. RH from the Hex community talks about this. Others have talked about this too. And all it's saying is when you have what's the network value? Like, what is this network? So Ethereum, okay, great. Everything goes tokenized. Okay, well, how the heck does that make Ethereum worth more? Well, it does because you have the number of users that come to that network. And this has been proven time and time again across all things that have a network effect. So the more people that come to that network, that use that network, it's going to make it much more valuable. So to put in perspective, today, the Ethereum price, we'll say it's $3,100. Let's just say, for give and take. If that were to kick in, and right now the user growth, we'll say is 1x. So if we had moderate tokenization, you're looking at about 10x of growth. That would put Ethereum around $12,500. If you had full US dominance, meaning Ethereum takes over, you'd get about a 20x. That would push Ethereum up to 27,500. And then just more of a much just hyper bullish, everything goes, you could be looking at a 50x, $183,000 price of Ethereum. Now, these numbers seem crazy, but what I'm trying to throw out to people to understand here is if you get this network effect where everybody's already telling you it's going to be tokenized. Now, we can only assume most of this is going to go to the Ethereum because it's the biggest guy on the block, does the most transaction, all this other stuff. Yes, there's Solana, there's some other ones that could gobble up some of that. But if everything's pointing towards Ethereum, you have a lot more upside to Ethereum than people quite understand. This is where Tom Lee's throwing out $63,000 out there to people on Ethereum network. Like that just seems like crazy, ludicrous. Well, it does until you start to understand the Metcalfe's law and the network effect. And that's what we talked about last week while Wall Street is trying to figure out how to price these vehicles. Like, how do you price this stuff? And what it kind of symbolizes here, what you're showing is that's the relationships or how many transactions that could potentially come in here, right? So all the different they call them connections, right? When these connections, each connection could be a new relationship or a transactional interaction. So as things transition to things, there's a transaction fee. Well, those fees get rewarded to the miners. That's money that's coming in. The assets that get put onto the network actually bring value to the network, and then just like I said, the number of users coming there gravitating to that will cause a massive amount of networks. This is why long term, to me, Ethereum is still going to be the one of the best ones out there to hold. I would say if I was more conservative, Bitcoin's the more conservative, of course, because it's ultra mesh adoption. But Ethereum to me is unfortunate. I feel like it's the next. It's not just the next one. It's this. How do I put it? I feel like it's the safest, most upside out there. That's how I would put it.
I think that's fair. If you consider that Bitcoin Bitcoin is arguably safer because it's less complex. The encryption is also a little lower tech, but that's neither here nor there. But the overall thing of what I think you're trying to get at there is that the outsized gains kind of lie with the things that are not Bitcoin, which is that Bitcoin has had tremendous runs. It has been the best performing asset in human history by a wide margin. But what we're looking at when it comes to the network effect, the big point that we're trying to drive is that the number of users increases linearly. So like the diagram we have on screen. This is a network comprised of 3, 5, 7, and 8 individuals. But the amount of connections that go between them rises drastically. It's almost parabolic, actually. So we go from 3 to 10 to 21 to 36. So what the network effect really is trying to get across is that, yes, the amount of people that come into it goes up on a flat line, but the amount of possibilities and all the connections that can be made go up way, way faster than that. Okay, that's kind of layer 1 of this whole thing. Layer 2 is, okay, I get it. You have more connections on the network. How does that affect the underlying asset price? Well, it does it in 2 ways. 1, increase in demand. Increase in demand means that more people need the thing to use on chain. For crypto and blockchain, that is the underlying gas token or whatever the coin of the realm is. So for Ethereum, obviously it's Ethereum. For other chains, it's whatever their token is. And then on top of that, there's all the different tokens that can be built on top of that as well that become widely used. So it's almost like a smaller picture and a picture of like one web inside of a much larger web, but they still kind of work in unison together. Part 2 of that story is that, well, if you have more demand for the base token itself, it goes up. But if you also have more people using these things, the way that they're designed is that the gas token is necessary to pay the people that are running the network. Okay, the more connections you have, theoretically more transactions. More transactions, more gas fees. More gas fees mean that the Ethereum is being used, and then people will have to resupply to get back. Granted, it's going to be very, very small in comparison to the amount of to the size of transactions going on, but it's a self-reinforcing system, which is that the more it's used, the more it's needed. And because it has all these possible use cases for the technology and the transformation of money, it seems kind of obvious that, like, look, it's the direction we're going. So this is going to solve a lot of issues. It's going to open up a lot more possibilities, like we showed with the Tom Lee clips last week. By the way, that was a really good stream, really good presentation he gave, really showing you what are all the like unthought of possibilities for new ways to use this technology. So there you go. Increased demand, increased usage, theoretically will drive up the base cost of the thing. In the past, with like the US dollar per se, as it's become more used around the world, well, we didn't have as many gas fees, or you could just call them taxes, sure. But at the same time, big difference on that side of the house, which is that the supply, US dollars has been printed ad nauseum. And I mean, one of my favorite jokes I like to show people is there's a chart of this one terrible coin that's lost 97% of its value as its supply has been inflated. And you're like, oh, wait, that's the US dollar. So I'm not saying crypto solves all those issues, but if you have good management of a token, it's going to solve a lot of them. So when we keep pointing back to different stories, like the JP Morgan story, where, okay, new markets are coming in, another connection. We didn't quite cover this one, but even the CFTC is talking about this new digital asset pilot program. They're looking at actually using tokenized collateral, aka stable coins, for derivative markets. Okay, another connection point there. And then it just keeps going down the line of all the different stories that we were getting a lot of this year. And it started out in 2024 as well with the ETFs and stuff, which is that there's more things coming down the pike. And there are more things that are really just pointing towards mass adoption of crypto. Is mass adoption going to make you rich? Not necessarily, but if you are, I don't know, paying attention to a bunch of crypto people on the internet talking about the future and stuff, odds are you're trying to get ahead of a market, and that's where you can really make a lot of outsized gains. So that's why I see the value in it. Tracker, do you have any disagreement with that?
No, I put my money where my mouth is too. Like
There
I'm
we go.
bet heavily in Ethereum. I mean, I've been betting on it for a while. Been probably in the Ethereum trade, probably going back to in Bitcoin as well, but I rotated my Bitcoin into Ethereum more aggressively, much higher in Ethereum by far. But yeah, I was backing the truck. I mean, I'm not going to say I was backing everything up, but I was throwing anything I had left into Q4 of 2022. I was just throwing everything at it. Of course, things just kept getting lower and lower, but Q4 of 2022 is when you wanted to back the truck up. Just throw everything you possibly could at it because things were so suppressed down. And then because of all these things, like we were already talking about this back then. Everything was telling you going this way. Now you're actually now hearing it from major players that it's coming, and you're seeing products already coming out. So now it's not a speculation. It's a full. You're seeing it come to fruition at this point. So there's nothing to speculate. It's going to happen. It's going to get much more aggressive. And then you see these little other things like where they randomly grab people in New York City and they gave them some crypto to start spending it into the in the city to see how they can function with it. There's all these little projects going on around the world to see how this stuff is going to interact and work, and they're doing this to do test cases. That's the whole point why they're rolling this out. Yeah, and the biggest people behind and the banks are starting to get on board heavily because they know this you're not slowing this down. If anything, the banks are scared because if this thing gets away from them, they would be essentially considered obsolete. Of course, they're not going to be because they have all the money in the world and they've got the leverage and the power to do so. So they're going to get ahead of this thing. The ones that were more on the sidelines have gotten in. I'm more shocked, if anything, to answer your question, am I surprised about any of this? No, I'm not. I'm more surprised that the other big three has not come in. Fidelity has. Was it Vanguard did? But where's State Street? State Street hasn't ejected. BlackRock has been in there. Like, all these players are here. When's State Street going to get involved? Like, I'm a little bit, I guess they figured, hey, 2/3 of the pie in there is good enough for right now, I guess. I don't know. I just think that's interesting how, and they all own each other, of course, but,
the incestuous relationship of each one of them owns 10% of the other ones. And then it's like,
yeah,
where's it going?
And
I'll say this though. I think so. Metcalfe's law, network effect, very powerful effect that we've seen used. I mean, gosh, back in the early 2000s when we were looking at like Facebook and MySpace and stuff, people are like, okay, this is cool, but where's the value? The value is the network. The value is all those people on it that have the accessibility and the ability to interact. Blockchain is going to be very similar. Okay, here's a counterpoint that I think is very important to think about when it comes to this kind of stuff. Great, network effect is so cool. What if they don't use your network? Why aren't they making their own? Well, I would argue this is emergent technology. It's very complicated. It's very difficult to do properly. At the same time, though, we have seen some forerunnings of large institutions trying to create their own networks. I want to reference, gosh, it was probably back early 2024. I want to say it was a handful of banks were actually trying to create their own private banking network on the Avalanche network for internal transactions. So there is some interest there. At the same time, though, why reinvent the wheel if it already exists? If there are blockchain networks that appear to be able to handle this kind of stuff and have the technology to do so and have a good track record of operability, that's a big part too for consistency and sustainability. I think you get arguments in both directions. I personally happen to think the argument is more in favor of using existing networks, A, from the technological standpoint, but B, also because there's an existing user base there as well. If you want to point back to the network effect, which the whole argument revolves around, the network needs users. If the users are already there, it's going to be a lot harder to try to draw them to something new as opposed to integrate into something that they're already using. Again, to go back to the old social media thing, it's like, I'm sure everyone's been trying to create the YouTube killer, the Facebook killer, the Instagram killer, whatever. But we see a lot of conglomeration and just consensus about what is the big one that everyone goes to. You kind of got to have everybody in order to be number one. And to try to beat number one, it takes a lot of effort, and it's very difficult to do. So could these large players create their own networks? Yeah, they could. We've seen them playing with the idea before, but I don't think we've seen any sort of mainstream success or success to the level that it's really going to rival the existing stuff. So I think it's important to watch. It's going to move fast. I think it's going to move very fast. So it's important to keep up with this kind of stuff. I'm not just saying that as a plug for us, but I'm just saying like crypto. Gosh, what do we say? Like what 1 year in crypto feels like 7 years in TradFi. It's the dog years rule. It's that kind of thing. So with the emergent technologies, if you want to be ahead of the curve, like we talked about, where you can really benefit from this kind of stuff, it requires vigilance. It really does. You got to stay on top of the ball, understand what's going on. At the same time, not necessarily saying you got to make transactions every day, because that would be financial advice, and we definitely don't give that here, but also because that's kind of just foolish, as we've seen from all the lessons of the 100 years of trading before this. But keeping up with the information, very important.
Yeah, interesting that you put the interoperability. I was going to touch on that because for folks that don't understand what interoperable what that actually means, and that is if you move everything to a network, now everything can communicate and talk to each other, right? It's very similar to the chart that Zena showed earlier. So another way to look at it is if you have we'll call them two things or widgets, whatever you want to call them, are out there and they can talk to each other, that is one relationship. You had three relationships, but you can see how it grows exponentially as you add more people to the network. Those relationships just multiply across the board, all those different relationships. Both if everything's interoperable, everything communicate and talk to each other, right? One big reason that's probably stymieing the mass adoption is probably the fact that things can all be seen. Well, keep in mind, the Ethereum network has already been releasing or working on the keeping things more private, right? Having things out there that are private. Once that piece gets in place, I think they're up, but once it fully gets in, consumed properly and set up, you're going to see a really quick move. And I think you're going to see it move pretty fast. I mean, keep in mind, like you said, Atkins out there, Paul Atkins talking about 2 years to 5 years. Wrap your head around that. All the market's going to be 2 to 5 years going to be on this thing. Now, like I said, the end user or most people that are even in there are not even going to know it's on that, but they're not going to understand that. They're going to be looking at it and still following this, but they're not going to understand that everything's been moved tokenized, like what that even means. But you're going to see an explosion. Now, going back to Metcalfe's law, when Facebook came out, there was a competitor. It was MySpace. Well, who won? Well, obviously Facebook won, and they took that whole lion's share. Well, but all it has is a bunch of people on there. What's the value? What's funny, because that company's worth how much? I mean, that's what that is.
One of the 7 largest companies in the Euro for Alert 2025.
That is the network effect. That is what happens. Well, how can they make money? Well, think about what Facebook has on it. You have businesses running off of Facebook. You have e-commerce. You have businesses. You have marketing ads. You have tons of stuff that can happen into the network. Think of another or realistic thing here. So if everything's tokenized on the Ethereum network, then you can start doing things like, and I'm just using this as a visual representation. People may understand this, but the movie Ready Player One, you get in there, you can buy assets, you can get things, you can, anybody who is a gamer out there, if you're in a game and it's not very popular, are those NFTs, are those items you have very valuable? Are they really desired? No. But if you have a very big game, that's one of the biggest games out there, and the items that are out there that are rare, those have a lot of value. That's another form of the network effect with people coming into it. So people need to understand that, and we're not even touching on the idea of what this will be used for. Like we said last week, Tom Lee did a convention that they had I think it was in Dubai, and they were talking about all the ideas just circulating. Do you think he's sharing all their ideas of what they think? Heck no, that's for their private investors. He just gave you a glimpse. Yeah, and he said himself, they have a team. They've got a team over there. They got quant guys. They have guys that are brilliant that are running for this kind of stuff. It's like, hey, tell me what would happen if this occurs or this happened. What's the probability? What's all this? So they've ran everything you can. They have resources at their disposal to figure out how this is going to be the best way going forward. And that's how they're justifying the prices of why they're going it. And what are they doing? They're buying aggressively. And other people are buying aggressively. Now, I know there's stuff going on out there with MicroStrategy about the banks are trying to short MicroStrategy and try to get them to be liquidated because their NAV, or don't want to get into this. Basically, long story short is they think that they could short and suppress the price to where eventually they would run out of capital to keep buying Bitcoin and cause the inverse. So as Bitcoin's going up, they're taking the profits from Bitcoin and they're buying more Bitcoin. Thus, it's capping the price off. right? So as they're making money, they keep taking the money out of the company. They keep buying more of the underlying asset, which is Bitcoin, which sounds great. Yeah, it's nice. But what happens when it starts going into a bear market? What happens then? Then you have the inverse. People are speculating, well, you could have more supplies being dumped on the market. And this is a threat to the banks. And then they're speculating even further. Well, why would they do that? Well, you can only speculate, but if they make them go out of bankruptcy and they short them, then they can liquidate the company. They can take all the assets underlying of the company they have. They're what they want. So there's those rumors going on as well. But ultimately, so personally, I'm not investing in those. I did when they first came out, and those were good trades, but I would not touch those right now just because it's an unknown product. You do not know how this is going to work. Now, if they get liquidated or all that, or supply gets dumped on the market, it's going to crash the prices, 100%. No question about it. But this is why markets are formed. It's all speculation. You can't just say this is a sure thing. But if things start tokenized and moving the direction they are, assets are going to become more valuable, period. They're going to become more valuable. So if you're holding long-term, like I am, I'm planning on having it long-term. We've been sharing a lot of this information on Walk the Block, guys, on our private channel, trying to keep everybody plugged into that. So everyone there has been very well informed of all this stuff that we've been thinking about, talking about, and we love to talk about it. So
that we do. And by the way, if you want to get in on those conversations, you can head on over to walktheblockndf.com, head over to the membership tab, and from there you can get into our private Telegram, and where we have exclusive live streams, the obviously ongoing chat all the time, post a lot of updates and articles and everything going on there. And if you have any questions, we are there to answer them for you. So we like to say, the waters get rough, so don't sail through them alone. Come join us as we navigate digital finance together. Private mentorships, exclusive live streams, Q&A. Go from beginner to intermediate to expert with us. And when we all work together, we can all win together, baby. Alrighty, good sir. Any final thoughts before we get out of here for the evening?
No, I'll just summarize. The Fed, Jerome Powell and them are going to base it off the data. There's no need to try to speculate. All we can do is look at the rate of where we're going. We're assuming it's going to probably come in around 100,000 jobs created at best, if not less. And the reason why that is because we're going into the holiday season. There could be jobs being created then. It's possible that is the reason why you might see a little bit better number there. But we expect there to still be, could be speculation. Don't need to even think about it until the time gets closer. But right now the market's leaning towards it's not going to happen. So if anything does positively happen, it's going to cause a direction to go the upside. Ethereum and Bitcoin prices are all been pulling back some. I think it's just, like I said, you're getting this rock to lull December. I don't think you're going to see any type of movements, really big movements happen until January, if they're going to happen. Still holding long. And for all the reasons we went over the show, I think there's going to be mass adoption to the Metcalfe's law, moving in with the network effect with the Ethereum network. And I think that's going to keep happening. That narrative will keep unfolding. So keep watching that. Looking forward to it. And we'll be back here again on Monday. Dive into what happens over the week. Keep building on it. But as you guys have been watching the shows, people who have been following the shows, you should start to see a theme. We're connecting all the dots. We're trying to connect why things are happening and why you're seeing this happen, so that you can see where direction we're going. And if anybody's been following us for even little shows, we're moving straight to tokenization, and it's going to move quickly. So buckle up.
Well said, sir. Alrighty, folks, that is all we got for this evening. I've been Zenith, your host, and my co-host, Tracker. Thank you guys so much for watching. We'll continue to be streaming 8 p.m. Eastern time here on the channel every Monday. So we look forward to seeing you next time, and we hope that you guys also have an excellent December as well. And like Tracker said, next Fed meeting's a while's away. So we'll maybe not talk about it as much, but also don't sweat it too much. A lot can happen between now and then, but still, stay frosty. We look forward to seeing you guys next time. Thank you so much. Good night.